Welcome back to Alpha Recap, your daily wrap of the market's biggest moves. I'm glad you're here. Today we're looking at a risk-off session that reshuffled leadership. And as always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. It was an interesting day. Not a crash, more of a rotation. And there were a few clear winners and losers to dig into.
Totally. Let's start with the big picture. Markets closed down across the major indexes. The S&P 500 finished the day down about 1.25%. The tech-heavy Nasdaq closed down just about 1%, and small caps dropped roughly 0.75%.
Right, so what really stands out here is that the pullback felt concentrated. Large cap tech and growth names gave back gains, while utilities, renewables, and some materials actually held up. Yeah, that tracks.
Walk me through why this happened. Was it one big headline or a collection of things?
It was a collection. There was concentration in leadership. A lot of the run-up had been driven by a handful of big tech names, so profit-taking was natural. Then you had mixed company news, where earning beats weren't always rewarded. Add in some sector-specific headlines, weak auto demand, for example, and investors got cautious.
And crypto was part of it too, right?
Exactly. Renewed selling in digital assets pressured crypto-linked equities, which tend to amplify risk-off moves because they attract speculative flows. So in token slid, related stocks felt the pain, and that bled into broader risk appetite.
So not panic, but a pick and shovel style rotation.
Exactly. Defensive sectors gathered flows and some cyclicals, with clear demand signals or deal news got bought. It was selective, not systemic.
Let's get sector specific. Which groups actually outperformed?
Utilities did well. Investors looked for income and defense. Renewables-linked names attracted attention after reports around project financing and regulatory momentum in key states. Materials and mining saw selective strength tied to deal and financing headlines. Some industrial and manufacturing tech names also picked up buying, especially those with visible order books or automation exposure.
So utilities and materials were the anchors.
Right. And the other thing is that consumer and media were more mixed. Discretionary was a split picture. Some categories held up, while higher ticket secondary market names were weak even after earnings beats.
That's a great segue to the individual movers. CarMax was in the headlines today. What happened there?
CarMax reported an earnings beat, but the stock fell. That was telling. It showed the market is leaning harder on forward guidance and margin durability than on a single quarter's revenue beat. Traders wanted clearer signs of inventory normalization and more confidence in near-term demand.
Hold on, say that again?
I mean, revenue beats alone aren't enough anymore. The market is focused on what management says about the coming months.
BMW also got hit. What's the story there?
BMW slid to a multi-year low in US trading on worries about regional demand and margin pressure. That's built into suppliers and luxury auto peers, which raised questions about discretionary spending in autos.
Ocular Therapeutics made moves too, with a drug filing update.
Yes, they flagged plans to file a wet macular degeneration drug in the fourth quarter. Small cap biotech reactions can be outsized on developmental milestones. It's a reminder that innovation headlines still create pockets of enthusiasm.
IQVIA was mentioned as a canary for healthcare services. What's the takeaway?
Post-quarter commentary raised questions about the durability of growth for outsourced research and data analytics. Investors focused on backlog, new contracts, and margin leverage, all things that signal whether healthcare demand will stay robust.
What about the banks? United Bank shares and Truist.
Both had idiosyncratic headlines. United Bank shares saw attention around regional credit trends. Truist faced scrutiny over guidance and efficiency plans. The financials were broadly muted alongside the market, a mix of single-name stories and macro sensitivity.
And Miller-Knoll and Sizzle brands cropped up in conversations too.
Yes, Miller-Knoll is in that office and commercial interiors bucket. Commentary on demand and margins keeps that name volatile. Sizzle brands is a tiny consumer story about diversifying beyond a flagship product. These microcaps can move intraday, even if they don't affect the broader indices.
Okay, shifting gears. The Fed was a backdrop today. How did today's action tie back to rate expectations?
The session kept the Fed narrative front and center. When equities dropped, markets tightened their focus on inflation and growth prints. If inflation were to surprise on the upside, that would push rate expectations higher and increase equity volatility. Right now, the move read more like consolidation ahead of upcoming data, rather than a decisive policy-driven reprice.
So it revived some recession chatter, but didn't confirm it.
Exactly. Some sectors, autos and certain discretionary names, sparked recession concerns, but selective strength in materials and industrials suggested this was rotation, not a blanket growth scare.
Let's talk technicals and historical patterns. Mid-June pullbacks. Are these normal?
They are. Historically, mid-June rebalances and caution ahead of summer can produce corrections. Today's move, a little over 1% in big indexes, is sizable but within normal correction territory. Often these pullbacks lead to consolidation or a renewed leg higher once investors digest earnings and macro data. Honestly, I was a bit surprised by how orderly it felt though. No panic selling, more measured repositioning.
Quick reactions. What's on your watch list for the next session?
Watch the economic calendar. Anything around inflation or labor data could shift the Fed narrative. And keep an eye on any Fed speak or former officials' comments. They can move expectations. Earnings follow-ups for the names that reported will matter, and flows into utilities and materials will be telling.
Short question.
Yeah?
Crypto. More pressure expected?
If digital assets continue to slide, crypto-linked equities will likely stay under pressure, and that can keep a lid on speculative risk-on segments.
And the final bottom line for listeners?
June 17th was a risk-off day, driven by profit-taking in large-cap tech and mixed company-specific headlines. The market rotated into defensive utilities and select materials and industrial tech names. It felt like selective repositioning, not an outright market breakdown.
Top takeaways for listeners.
1. Markets closed down, but it was selective. The S&P finished down about 1.25%, NASDAQ down about 1%, and small caps down roughly 0.75%. 2. Company commentary and guidance carried more weight than single quarter beats. 3. Utilities, renewables, and some materials showed resilience, while crypto-linked and discretionary names absorbed the worst of the selling. 4. Keep watching inflation prints, Fed commentary, and flows into defensive sectors.
Quick reactions. Right.
Short and sweet.
Before we go, a reminder. This discussion is informational only. We're not giving personalized investment advice or recommending buying or selling any security. Analysts note trends and data, not individual guidance.
Exactly. Analysts' observations reflect market data and commentary. Always use multiple sources, and if needed, consult a licensed professional for personal advice.
Thanks for joining today. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That's stockalpha.ai. Ask us a question and we'll follow up.
Thanks. Catch you tomorrow for the next recap.